Hi, welcome to SGA Depreciation Revisited and Taxes. Okay, so let's start right in with SGA. SGA is short for Selling, General, and Administrative. Okay, and universally, this is contracted to SGA expense. Okay, and these are going to be expenses associated with, of course, routine production of goods and services that are not. Okay, this is the way to think about SGA that are not COGS, interest, depreciation, write downs, other income or other expense, which we will get to soon, or tax. Okay, and what this is going to mean is that sometimes when we've been very careful about individually identifying expenses in the past, sometimes companies will lump a lot of these together into this bucket called SGA, but you cannot throw into this bucket COGS, interest, depreciation, write downs, other income or other expense or tax. Okay, so far so good. But it wouldn't be accounting without an exception. Okay, also, SGA needs to exclude, depending on industry, company, etc., some other separately reported expenses. And we'll see how that works in a second. Okay, so what are the types of things if we want to throw a bunch of expenses into one bucket and show them as one line on the income statement? What could these be? These could be something like advertising costs, accountant salary, headquarters rent, and maybe R&D. That's going to depend on the industry. Okay, so like I said, this is gonna, when we use SGA, it's gonna lump together some of the accounts we've reported individually previously. Okay, and we're still gonna record them when we're doing our journal entries or transaction table entries. We're still going to record things with a lot of care because we might decide to do an income statement without putting anything into SGA or for any other of numerous reasons. It's always good to be very specific when we record, okay, as opposed to when we're making an income statement itself. But let's look for a second at this R&D example. R&D. So for something like Google, it's going to be something like 20% of revenue. That means this is material, okay, and that's going to mean don't want to put this in SGA, okay. All right, so for something on the other hand, like container space, okay, it's going to be similar to maybe 1% of revenue or less, okay, and that means it's not material, okay, and that means that we could put in SGA. So you see how sometimes, depending on your industry and that sort of thing, you might be able to put some things in SGA, and if you're in another industry, you wouldn't be able to. Basically, anything big, important to the heart of your business, you don't want to throw in there. So that would be true for Google, Microsoft, Facebook, etc. All of them have R&D expenses, about 20% of revenue. So they should be showing those separately. Otherwise, they're being obfuscational. Okay. All right, so one other thing you should know about this, I'm going to go to the middle of this page, is overcondensation. You should know when you find accounting data online, it's peppered with mistakes. Yahoo Finance, Google Finance, et cetera, et cetera. Sometimes, for example, you will see At Yahoo Finance, depreciation folded into SGA. That is wrong, 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 right? Depreciation never goes into SGA, okay? And how does that happen? They hire computer science graduates who have never had an awesome accounting or finance course, like this awesome accounting course, and they don't know the rules, and they read something on the internet and they get things wrong, and it goes into Yahoo Finance. So you want to be careful about that. The only two really good providers of information on the internet are S&P has a service, it's about $1,000 a month. FactSet has a service, it's about $1,000 a month. And also I would say the SEC itself, of course, is good. That's where companies directly file their financial information. But that's about it. Everyone else is buyer beware. What do you expect when you get stuff for free? Okay, so SGA expenses are period expenses, so we only want to put period expenses in there, so they're not going to be matched to revenue. Okay. All right. And let's do an example for container space. Let's consider a one-day reporting period, okay? And let's find journal entries and IS for the period, but I just want to add here, put as much into SGA as possible on the income statement. Okay, all right, so let's go ahead and see. So we've got this one-day accounting period. Its accounting staff earned $1,000 in salary. It purchased sales flyers costing $500 on credit. So this is looking to me like a candidate for SGA. Also accounting staff salary, not inventory period expense. I think that could go into SGA2. Single shop employee worked all day on a container, earning $400. That, as we know, is definitely inventory, no expense associated. All right. Okay, no expense associated with this yet. So let's see what we've got for our journal entries here. We have our salary expense here. That was for the employees that are not inventory, so that can be SGA. And that marketing sales expense, well, selling general administration, that's a hint that that should definitely be SGA. And down here, like I said before, no expense. Okay, so let's see what the income statement can look like when we put as much SGA in there as possible. All right, so in this period, the revenue was 0, and we could put all of the expense items. There were only 2, but we could put them both into SGA, the 1,000 in salary and the 500 in marketing expense. So if we're choosing to put all those expenses in one big SGA bucket, this is how it would look, SGA expense. And that includes the accrued I don't want to say accrued salary here. That includes which salary? I think it was accountants. Yeah, so let's do that. I don't want to say accrued because then people get confused with liability. Okay, so let's just say accountants, salary, and marketing expenses. Okay, and note that CS does specifically identify the salary and marketing expenses when they are recording events, and that's what we want to do too, okay? So you only aggregate this information when creating an income statement, and I'm going to say if you are choosing, and in this class, of course, it would be told to condense into SGA. Okay, and so that allows us to have very finely grained internal reports and still have relatively terse financial statements for external folks. Okay, I think we got the key points out of that. This little table that you look at on your own just talks about some of the differences between COGS and SGA. But now let's get to the topic of depreciation revisited. Okay, remember what depreciation is, right? It's the process of expensing the cost of a long-lived asset, okay, such as PPE, over its useful life. Okay, and accountants would say we're matching the cost of the asset to its useful life. Okay, and another way to think about it is the process of reducing the book value of a long-lived asset as its useful life decreases. Okay, and as we know, the useful life of something is not actually necessarily the life of the asset. And buildings for PPE are a prime example. Buildings may last hundreds of years, but you buy a commercial property building or industrial property building and you depreciate that over 40 years, even if your company is going to own it for 200 years. Okay, so let's go over what we've been doing with depreciation and a slight adjustment we're going to make now. Okay, so Container Space has some CNC mills. Here's an example one they use to fabricate door and window framing for the containers that it's modifying. So let's say they purchased this one on 12/31/2007. Okay, and for this mill, it cost $50,000. They estimate it's got a 5-year expected useful life. Okay, and no. And what that means is it's going to be worth zero at end of useful life. So they can't sell it for anything. Can't resell it, etc. Okay, it's just going to go down to zero. Okay, and they use straight line depreciation. That's all we're going to use for anything in this class. So if it's 5 years, they're going to whittle away 20% of the value every year. All right. So here's how we've learned to account for something like this uh, so far. Okay. So our end of year journal entries for the life of the mill, first when they buy it, it's going to be credit cash, 50,000, right? They paid cash for it. And then they're going to say DR net mill asset, or we could have said instead net PPE. I'm just showing, individual components of PPE here. So that's why I said net mill asset. Um, and that's DR because that's the new asset that they have that they're going to use for a long time, 5 years, to help them make money. Okay. 1 year later, they need to reduce the book value of the mill by 20%, and they're going to incur the expense for 20% of the mill's value. Remember, the idea is we recognize the expense for the cost of the mill over its useful life, so 20% a year. Okay. All right. So how's that look? So first of all, we want to recognize the wear on the net mill asset. So that's going to be down by 10,000. That's 1/5 of 50,000 in most circles. Um, and where does that go? It's always gone to depreciation expense. All right. So far, so good. Um, this is not exactly what GAAP requires. What we have been doing, okay, this is common finance method for recording depreciation. It's what we often do in finance. It's first, it makes sense, it's clear. But what GAAP accounting requires is a little more complicated. So let's go through it. through it right now. Okay. And why haven't I tortured you with the gap treatment yet? Well, as Jack Nicholson might have said in A Few Good Men, you couldn't have handled the truth. Okay. We've had so much to learn in accounting, so much vocabulary to learn. Like Warren Buffett says, accounting is the language of finance. You've had to learn the syntax, the sentence structure, the grammar, the vocabulary, a lot of vocabulary. And so I've wanted to keep things simple. And the finance way of handling depreciation is one way that I've found to do that. Okay. Also, we could look at in physics, the first time you do a model of projectile motion, you get something that's very easy. You integrate twice and get a parabola and all that stuff. And then when you get into ordinary differential equations classes, things get more complicated and you have to simultaneous linear ordinary differential equations to solve, which takes a whole other level of math. So same sort of idea here. We're starting with something simpler and we're getting more complex as we move on. Okay, so here is the gap method of thinking about PPE and depreciation. What is going to happen with gap is on balance. We want to show the assets at cost. Right? So this would be right, PPE at cost minus total depreciation, okay, that we've recorded since we bought this sucker, okay? So notice how we're showing here, first of all, PPE, not net PPE, okay? So we're showing the total amount that we paid for these buildings, these trucks, whatever it is, minus the total amount of wear. Okay, this is cumulative, right? And that's why it's called accumulated depreciation. So all the wear we've ever recorded on this PPE, we subtract that and we get today's book value, or exactly what we've been calling previously net asset or net PPE. All right, so we do this on balance sheets for the life of the asset. Okay, and so here's how we keep track of this in the gap method. Okay, when a depreciable item is purchased, we're going to establish the asset account, something like mill asset, not net mill asset, something like PPE, not net PPE. And we're also going to establish an accumulated depreciation account, called by accountants a contra asset account. Okay. And we're not going to do anything with that account yet. We're just going to set it up, but we're going to note that this is a CR plus account. So when we add to it, we get CR. Okay, but it's associated with an asset. Okay, so we use CR when adding to the account, but it's associated with an asset. So that's why we call it a contra asset account. Okay, and this is always on a balance sheet going to be placed just below the asset itself, just like I showed over here. Okay, we have the PPE, not net PPE, minus accumulated depreciation equals today's book value. These two, the PPE and the accumulated depreciation, are always shown together on the balance sheet. So it's very much like a shark and a pilot fish. The pilot fish is always right next to and just below the shark for its life. It's also going to be true that when the shark dies, the pilot fish dies. Um, and another way to think about this is if the shark is Obama, after Obama's two terms, his pilot fish, which would be Joe Biden, would be useless and nobody thinks about him anymore. So Obama, shark, Biden, pilot fish, and that's a good analogy for this too. Okay, um, so now let's do the journal entries for the life of the mill using accumulated depreciation. So the gap method, right? So when we buy the mill, okay, it's going to be exactly like we did before, okay, except we're going to say mill asset, not net mill asset. Okay, not net mill, right? Or PPE, not net PPE. Okay, and they still paid the 50,000. So we're also going to set up this accumulated depreciation of mill account. Okay, we have no journal entries yet. We're just going to set it up. Okay, so we have a pilot fish going with nothing in it. All right. So a year later, okay, so 1 year later, we reduce the book value of the mill by 20%. We want to report that 1 year's worth of wear. We want to expense 1 year's worth of wear on this mill. Okay. So now the way we record this is we still record just like we did before depreciation expense. Okay. But instead of net mill asset, okay, instead of net mill asset, we're going to say CR, that accumulated depreciation pilot. Okay, so that's the difference. All right, we're always every year we're going to add to the accumulated depreciation account, and the mill comes in at PPE or mill asset, not net in both cases. Okay. All right. So what's our balance sheet going to look like now at the end of the first year? The mill asset, this stays at 50 for the life of the mill. Okay. And because it's not net, right? Not net. And then we say on the next line, we have the pilot fish. Pilot fish cumulative balance on the next line. That's negative because remember it was CR plus. And what we bought the mill for minus the total amount of wear is the book value, or what we called previously net mill asset or net PPE. Okay, so you can see what we did the finance way is just a little simpler, a little less complicated, but they both get us to the same place, which is to show the 40,000 book value at the end of 1 year. And the income statement here is going to be just like it would have been using the pure finance method, depreciation expense of 10,000. Okay, let's go 1 year on. Okay, we're going to reduce the book value of the mill by 20% and incur our expense for 20% of the mill's value. Okay, so once again, we say depreciation expense, that 1 year's worth of wear, 1 year's worth of cost of the mill that we want to recognize as an expense. And now on the other side, we once again add to that accumulated depreciation account, okay, and by another 20% of the mill's value. No entry to the mill asset. Remember that stays at 50 for the whole life of the mill, right? So stays at 50 for entire life of, right? Okay, looking good. All right, so now let's think about our balance sheet and our income statement for the year. So the mill asset is still going to be 50K. The accumulated depreciation now is, remember, everything on the balance sheet is cumulative from nanosecond zero. So that's going to be minus 20K equals minus 10K plus another minus 10K, right? For 2 years. So this would be for 2008, and this would be for 2009, right? And so the book value of the mill is now 50 minus 20 is 30 in most circles. So I think we are looking pretty good. And if we wanted to make things look nice, we would underline that. Okay, so the income statement, depreciation, there's been 2 years. We should put 20 in there, right? No, we want on the income statement is always just for this year, right? Not cumulative depreciation, just depreciation incurred in the year. So that's going to be 10K, and that is 209 only. Okay. All right, I think you all are getting it. I sense out there in the ether. So I'm going to jump right to now the end of the mill's 5-year life. And so what we want to do at the end of its life is we need to take the last 20% of wear off this mill and record it. So just like the other 4 years, okay, we're going to record the depreciation expense and the accumulated depreciation. So this is just like prior 4 years, okay? And then we want to ask the question, the mill's useful life is over. Do we want to have this mill on our balance sheet anymore? No, right? The useful life is over. So we need to remove the mill. So we've been holding that mill asset at 50, at DR of 50. So we subtract with CR mill asset 50,000. That brings it to 0. So that brings the balance to 0. Okay. And on the other side, we have, what did we have in the Joe Biden account, in the pilot fish account? We had 50,000, all CR. So now we have to bring that. Remember when the shark dies, the pilot fish dies? So this brings the balance to 0. Okay. All right. So now let's think about our income statement and balance sheet. Starting with the balance sheet for this year, the mill asset is not shown. The accumulated depreciation is not shown. All right. So remember, our rule is here that on a balance sheet for any account with a 0 balance, we don't show it. Okay, so the mill asset balance is 0, accumulated depreciation is 0, we're not going to show them. But the income statement we have for, we do want to show that last year's worth of depreciation expense for the year 2012, right? Okay. All right. Hopefully that's making sense to you. And I think that's a good place to end with the technical stuff. And now let's think about this a little bit. So, should Container Space throw away the mill at end of year 2012? Are the accounting police going to rush in and inspect them and throw them all in jail if they don't throw the mill away? No, of course not. So they want to keep the mill, let's say, how about not, if working well and okay with yeses. CS may just have a policy that they want to stop using all their mills at the end of 5 years, just because it's been their experience. Maintenance costs go up very quickly after that. They want to stay on top of the new technologies that are coming out in CNC mills, something like that. But aside from that, if the mill is working well, they should, of course, keep using it. Okay. And so let's say they do keep using it. How will this impact its profitability? Let's look back here. Are they still going to have this depreciation expense in 2013? Nope, it ain't going to happen, right? So all else being equal, are they going to be more profitable or less profitable? They're going to be more profitable because they have less expense. So it's going to increase profitability because there's no more depreciation expense. Okay. Do depreciation expenses ever result in cash flows? Well, let's go back to some of our journal entries for depreciation expense. In all 5 years, depreciation expense 10,000. Was there ever cash on the other side? No. Could there have been cash on the other side? No. So we're going to say no, of course not. So let's say check the journal entry for depreciation expense. Okay, does depreciation expense matter? Might so well never have anything to do with cash. It might not matter, but I'm going to say yes, it does. It shows us it is indicating roughly of our wear of our PP. Of course, this doesn't work well for buildings, but it does work reasonably well for other things. CNC mills, trucks, computers, stuff like that. Okay, and it sort of shows what we should save to replace our PP. And it's just sort of showing us what we should be saving up or have available in a line of credit or something like that. So yeah, I think it's good. Good. Okay. All right. So now we're going to take a quick break again, and we're going to come back and finish up depreciation with salvage value and a few things like that. So we will be back in action in just a second.